Hi, welcome back to Cbse Board Economics. Today we'll be discussing another important method of estimation of national income by income method. You recollect and refresh your memory. Last time you learned how do you estimate national income or national product by value added method or product method or net output method. We discussed the precautions you should be taken while calculating national income by product method, and we've seen the formula to estimate national income. Now today we will be discussing another method of estimating national income, that's called income method. By income method, you get the same answer what you got it in product method, because in economics we say a penny of goods produced is equal to a penny of income generated. To put it in simple words, whenever we do production, obviously income is generated. If you produced a pen, of course you sell it in the market and you get income. So let's see how do you estimate national income by income method. Let's see the definition of income. Product method definition which you got at national income: the total money value of all final goods and services produced in an economy in an accounting year. That's a product method definition. Income method, national income is defined as the total factor incomes accruing to the normal residents of the country in an accounting year. I repeat once again, national income is defined as the total factor incomes accruing to the normal residents of the country in an accounting year. The total factor incomes accruing to only the normal residents of our country, not the non-residents, in an accounting year. The total factor incomes accruing to the normal residents of the country in an accounting year is defined as national income. Let's see what are the four factors which you already learned. There are four factors of production: land, labor, capital, entrepreneurship. You learned it earlier. What we pay to them is called factor payments or factor incomes. We pay rent to land, wages and salaries to labor, interest to the capital, and profits. Let's go into details of this. How do you estimate national income by income method? The first step, again here we take the steps. These steps are given by Central Statistical Organization, CSO. The first step is classification of industries which employ factors of production. All the industries, they employ the four factors of production, that's land, labor, capital, entrepreneurship. Without these four, we discussed it, we just can't think of doing any production. Which are these industries which employ the four factors of production? One is primary sector. What is primary sector? This deals with the exploitation of natural resources. These factors of production are working in these. Maybe some people are working in agriculture, some people are working in industries, land, labor, capital, entrepreneurship, and some people are working in the tertiary sector. And secondary sector, manufacturing sector. Some of them are working in this, and the last one is tertiary sector. This is called service sector. So this is the first step, classification. The same way what we did it in the product method or value added method. The first step is classification of industries. All the industries are classified which employ the four factors of production as primary sector, secondary, and tertiary sector. The next step is different here from the product method, estimating factor payments or factor incomes. I just told you when you employ the four factors of production, we have to pay them. So how do you estimate the four factors payments or factor incomes? The first one is, I told you, to laborers we have to pay wages and salaries. That broadly in economics we call it as compensation of employees, COE. Compensation of employees. It has three components here. One is wages in cash plus wages in kind, and the last one is employers' contribution to social security schemes or social security contributions or schemes. What it means, I'll tell you. So if you are working in a big company or in a big firm, The compensation of employees, they provide you wages in cash. This cash can be salary, this cash can be commissions, this cash can be bonus. You take all of them. And so in some jobs, they provide you wages in kind. What exactly is wages in kind? This can be, in some jobs, they provide you free food. They provide you a lot of facilities. They provide you house, free house to stay. In some jobs, they provide you free mobile phones. They provide you all the other, whatever they provide you in kind. It can be in some jobs they provide you medical facilities, free medicines, free food, free clothes, whatever you're getting it, right? That is called wages in kind. It depends upon the job. So if you're working in military, they provide you free food, free accommodation, free clothes, and a lot of free rationing, a lot of things they provide you. That is wages in kind. And last one is social security contributions. This is to protect your life. Your employer protects, gives you security. This can be in terms of gratuity. This can be in terms of pensions. When you retire, this can be in terms of whatever social security, they ensure your life. So this is you should take all of, if they given you in the numerical compensation of employees, you're not supposed to take it. In case they give you separately wages in cash, please take it, plus wages in kind, plus employers. Don't take it employees, employers, contribution to social security schemes. The first step is classification of industry into primary, secondary, tertiary, which employ the 4 factors of production. The second step is estimating factor payments or factor incomes in these 3 sectors. Number 1 is compensation of employees, which has 3 components: wages in cash, wages in kind, and employers' contribution to social security schemes. The second one, we are talking about the factor payments. Rent is paid to land, which you know it. Rent and royalty. What is royalty? Royalty is a payment made for the use of underground wealth, mines, coal mines. When you give it, you get royalty, or for the use of patent rights or copyrights or trademarks. So some people have the trademark, they give it to someone else to manufacture, so they get royalty. So royalty is a payment for the use of underground wealth, okay, patent rights, copyrights, and trademarks. That is royalty. It's a kind of rent. And interest is paid to the factor of production capital. And next one is profit. Entrepreneur get profits. Again, profit has 3 components. Which are the 3 components of profit? One is corporation tax, and one is undistributed profits and retained earnings. What it means, suppose if a firm, Reliance Industries, make a profit of 100 crores. Out of these 100 crores, the Reliance Industries have to pay 40 crores to the government as corporation tax. And now the firm is left out with 60 crores. What do they do with that? A part of 60 crores, the firm keeps itself for further development of the firm. This in economics, we call it as undistributed profits, or we call it as savings of the private enterprises, or account students know it as reserves, undistributed profits or savings. And the last part, whatever is left, the firm distributes among, this is profits, undistributed profits or retained earnings, they call it also, I'm sorry, here. And the last one, this is the same thing, undistributed profits and retained earnings. And the last one, plus we call it as dividends. So profit has 3 components: undistributed profits or retained earnings or corporation tax plus dividends. So I repeat, profits has 3 components: corporation tax plus undistributed profits, or we call it as savings of private enterprises, or retained earnings, and the last, whatever is left out, the Reliance company distributes among the shareholders as dividends. If they give any profits, don't take all this, or profits, you add up all the things, you get profits. So in economics, we say one more, this rent plus royalty plus interest plus profit, we call it as operating surplus. What exactly is operating surplus? We discussed it in one of our earlier episodes. What exactly is operating surplus? The sum total of rent, royalty, interest and profits is called operating surplus. Operating is sum total of rent plus royalty plus interest plus profits. Keep in mind. The last one we have is mixed income. What exactly is mixed income? We discussed in one of exclusive episode for mixed income. I repeat once again, mixed income is the income of the self-employed people. Like in India, we have most of the people are working in corporate, unincorporated enterprises, which are these small business firms. This can be small shopkeepers, this can be doctors practicing at home, this can be lawyers practicing at home, this can be small tour operators, this can be small coaching centers, these can be barbers, this can be beauty parlor. In these small enterprises, they do not maintain profit and loss accounts and they do not maintain proper balance sheets. Why? Because they provide all the factors of production themselves. That's why you cannot divide their income as income from property and income from entrepreneurship. Because in their income, you have all the components of four incomes. That's why it's called mixed income. I repeat, mixed income is income of the self-employed people like small shopkeepers, small business firms, maybe small tour operators. Since they do not maintain proper accounts, they do not maintain profit and loss accounts, and they do not distinguish their income from property and entrepreneurship, hence it's called mixed income. So we should take this also. And the next step is, see, estimating NDP at FC or domestic income. You just add up all these factor incomes within the domestic territory of a country. You add it up, all these factor incomes. Now what it means, you just add it up, compensation of employees plus rent plus royalty plus interest plus profits plus mixed income. You get NDP at FC or domestic income. Very simple, within the domestic territory of a country. Or to put it this way, you add it simply as COE plus operating surplus. That takes care of all these four, plus operating surplus plus mixed income. Only three. COE plus operating surplus plus mixed income will give you NDP at FC or domestic income. And the last step is, to this you add net factor income from abroad, estimating NNP at FC. NNP at FC is equal to NDP at FC plus NFI, net factor income from abroad. Net factor income from abroad is the difference between factor income received by the residents of the country and factor incomes paid to the non-residents within the domestic territory of a country. It will give you NNP at factor cost or national income. I sum it up once again to make you understand. In the income method, we estimate the national income by taking the factor incomes or factor payments. We can define national income through income method as the total factor incomes accruing to the normal residents of the country in an accounting year. What are the steps we take in income method? The first step is, you can see here, classification of industries which employ the four factors of production. All the industries which employ the four factors, land, labor, capital, entrepreneurship, we classify them into three categories: primary sector, secondary sector and tertiary sector. The second step is classification of factor payments or factor incomes. All the factor payments are classified into one, compensation of employees. It has again three components: wages in cash plus wages in kind plus employers' contribution to social security schemes. The next one, you have rent and royalty, then you have interest, then you add, which has three components: corporation tax plus undistributed profits or retained earnings plus dividends. To this you add mixed income of self-employed. When you add up all these factor incomes, you get NDP at factor cost or domestic income. And the last step is, to this if you add NFI, net factor income from abroad, you get NNP at factor cost or national income. To put it in simple words, so to do numericals, just add it up: COE plus operating surplus plus mixed income. NDP at FC or to this you add plus NFI, you get an NP at FC or national income. That's pretty simple. That's all we have time for today. I'm sure you must have followed it. The income method of measuring national income. Precautions will come in the next episode. Till we meet next time, it's goodbye from Saddam Hussein. Best of luck for your exams. Please don't forget to subscribe, share, and like, comment our videos. Till we meet next time, it's goodbye.